I think they should have cut last year. I predicted after the bank failures they would, but they didn't. Here's the truth of the matter. Everyone on Wall Street knows after a tightening cycle, the Fed rate hikes, the Fed starts cutting rates, it's a bad sign. And so the Fed didn't want people to think they were scared, I think. So I think once they cut, it's going to be not a 25 basis point cut. I think the first cut will be 50 to 100.
Ed Dowd, founding partner of Phinance Technologies, which is an alternative global macro investment firm. It is so great to welcome you on the show and great to meet you. I really appreciate you taking the time, Ed.
Thanks for having me on, Julia. Great to be here.
I'm so excited to have you on, and I feel like there is a lot to discuss these days. And Ed, I want to start where I always start with my guest, and that is just to get your big picture macro view, the framework in which you're looking at the world today. And one of the things about this show, Ed, is you can take all the time you need when it comes to setting the table for that macro picture.
Sure. I mean, the bottom line is this. We're, in our humble opinion, close to some sort of reckoning on the global debt problem that we've accumulated since the Great Financial Crisis. The Great Financial Crisis was solved. We solved the debt problem by creating more debt. And global governments went on a spending binge, and the interest rates were at zero for 14 years. Then we had COVID. COVID was like a war. The spending we did was warlike. It created inflation. And now the Fed just raised interest rates 550 basis points, the fastest rate hike ever in history. The rate of change was unprecedented. So now we have monetary policy tight. We believe that the rate hike cycle has peaked, and that the lagging effects of that cycle in terms of drying up liquidity are just hitting now. So we believe on the precipice of a slowdown in the U.S. economy and probably the global economy, and we'll see what happens after that, what the Fed's response and the global government's response will be. Unfortunately, since COVID, the wealth inequality has gotten even larger. We have people at the top with unprecedented amounts of wealth and concentration, and inflation has brought a squeeze to the middle class. The middle class is getting squeezed, and indicators in the real economy suggest that a slowdown is coming. It should have occurred last year, but the government did unprecedented deficit spending to juice it into the election. So we're just waiting for the pieces to fall into place to see some sort of correction in financial markets and a response from the Fed.
Great frame up to the conversation. And just to the point about the deficit spending and the role that is playing in the economy, sounds like it's an economy that's been propped up, and maybe it's not so healthy.
No, it's not. And the real economy, as indicated by, just talking to anybody out there, is that they're struggling. Credit card delinquencies are on the rise. They're above 2020 levels. Auto delinquencies are on the rise. We see reports from consumer-facing companies saying their consumer is squeezed. So the real economy is not good. Job growth, there's been a lot of controversy around job growth. And there's actually a statement by the Federal Reserve President Jerome Powell at the last meeting that there's questions about the accuracy of the payroll numbers. So we have potentially a government juicing not only deficit spending to create what have been essentially government jobs. The real economy has been losing jobs. So what we're going to see is kind of unfortunately, I think when the realization of the health of the economy hits, it'll hit fast in the financial markets.
Mm-hmm. And that's the correction you're referring to. Let's talk about the state of the financial markets. You've been in this industry for, over 30 years, correct me on the number there, but you've been in the business a long time. When you look at the markets, what is your assessment?
Well, the stock market going into 2022, the peak in 2022, was a lot healthier than it is now. And then it rolled over because of the rise in interest rates and the slowdown that brought immediately. But now we have the real effects of the interest rate hikes hitting about 18 months later. The money supply went negative November of 2022 for the first time since the Great Depression, year-over-year growth. You roll forward, it takes about 18 months for monetary policy to really hit. 18 months was May of this year, so last month. And if you look at the stock market, which is what everyone looks at, it is one of the most unhealthy stock markets we've seen in a long time. It's being propped up by about 5 stocks. We're seeing divergences on advanced decline lines. We're seeing the Dow Jones Industrials failing to make a new high, the Dow Jones Transports making new lows, the Value Line Index making new lows. So there's this disconnect in the U.S. stock market that eventually will come home to roost. And NVIDIA is currently on the table right now. It's being talked about because it just hit what I thought was potentially a blow off top. It may have peaked. We'll see. I'm not convinced yet that it's peaked, but if that's peaked, then we're going to have a tough summer in the stock market. And I suspect we're going to see, going into the elections, a lot of uncertainty and more reality in the economic numbers. And a lot of people are going to freeze decision-making business-wise before the election. So that's going to have an effect on the real economy as well.
Yeah, we'll definitely get into that as well. I guess for someone who you ran like an equity portfolio back at like BlackRock back in the day, and I don't know if you still you probably, I imagine, still have conversations with other folks who are running funds and maybe equity funds in particular. Is it much more difficult now to be like more like a fund manager these days when you have just like 5 stocks that are propping up the entire market? Is it difficult? Because I imagine you have to beat the benchmark. I don't know if you have an opinion there, but just curious.
Yeah, so this has been a problem in financial markets forever and in managing money. So you are correct. It happened even when I was managing money. Going into the 2007 top, the market became extremely narrow, and there were like 10 stocks leading the charge. Now, in my growth fund that year in 2007, we knew the economy was slowing, but we had the right stocks, but we knew we were playing a momentum game. We knew at some point it was going to end in reverse. So we were lucky enough to, not buy our own nonsense, knowing that momentum eventually stops and rolls. So if you're a money manager today, you're chasing these stocks because you have to, because you can't beat the benchmark unless you're in them. So that's what's going on. It's the crowding effect. Everyone goes into the same stocks. All the hedge funds are in the same stocks. And at some point, tops are made not from people shorting the top. It's made from the buying power drying up at extreme prices. And once retail gets in, there's just no more buyers. And then we start to see the market decline. And then because of the rapid rise in the leverage used, it unwinds pretty quick. It's just, this is just cycle after this. There's nothing new. It happens every time.
Yeah, that would result in like that fast and furious correction that you foresee as like when the buying runs out. Is that correct? Like maybe the catalyst?
Yeah, and also NVIDIA is it's a great company. I'm not going to say it's not a great company. It's been a phenomenal stock. But if you look at what has propelled their latest revenue beats, there's a lot of hype about AI. There's a lot of private equity investment in AI startups. And part of the funding of those AI startups, the first thing they do, and NVIDIA is invested alongside a lot of these new companies, they buy NVIDIA chips with their capital. But they don't have any revenues yet or business models for the most part. This reminds me of the CLEX in the telecom.com bubble that got funding from junk bond markets. These were going to be the competitors to the established telecoms, and they bought tons and tons of telecom equipment, but eventually they couldn't keep buying equipment because the revenues never showed up. So at some point, NVIDIA, which is a semiconductor stock, that's, the laws of semiconductor cyclicality haven't changed. So that's, at some point, the market will discount that. There'll be no more buyers. And maybe that happened last week. We'll see. There was a technical indicator on NVIDIA that my friends on Wall Street follow. It was the DeMark trading systems. It measures exhaustion both to the up and the down. And it coded on the day it topped a 13 DeMark weekly, and a 13 daily. So that's 2 time frames. So there's technical indicators that may have picked the top as well for NVIDIA, but we'll see. I mean, I'm not calling the top, but it's on watch. And if that cracks, the whole market's going to struggle this summer, and then we'll see what happens.
Yeah. Let me ask you this though, like with that in mind, that scenario, that thesis, how are you thinking about maybe how you might want to play this or be allocated? What can you share there as it relates to like, allocation or thinking about even opportunities?
Well, so I've been telling people for a better part of a year and a half to take some portion of their wealth and put it in T-bills or money market government funds. And I'm not alone in that viewpoint. Warren Buffett currently owns 3% of the T-bill market. The current T-bill market, Warren Buffett owns 3% of it. So Warren Buffett is accumulating cash. A lot of people I talk to are accumulating cash, and they're just sticking it in 3-month T-bills and rolling it, or government money market funds. And the idea is you're not going to be able to exactly pick the top. You're not trying to make money off the decline because that's risky, and if you're too early, you can get blown up. So what's the point of that? You have dry powder for the correction, and when the stock market declines, usually in a recession, we've seen, the last 20 years, we get a 50% correction in the stock market. If we get that, then you just kind of roll back in and take advantage of the low prices.
Okay, so that sounds like it could be a real opportunity then, especially, for maybe, I wonder, like, even like when you think about like more like demographics, you were talking about like wealth inequality earlier. A lot of conversations on this channel, and I love my boomer viewers. I love you guys for sure, but like it has come up like this conversation around like, maybe younger generations aren't doing as well. So maybe that's an opportunity for them.
I've said in another interview that was based on the economy and financial, I said there's a lot of hope for a lot of millennials and Gen Z that have accumulated some assets. It's a great opportunity for them to buy low if they keep it in cash. Meaning, let's say you're 30 years old and you have $100,000. You might have a good opportunity to buy the lows and then, multiply that 5-6 times over a 5 to 10 year period, just because you timed it correctly. The problem for this generation, the younger generation, is asset prices are so high, so inflated, it's hard for them to get involved. So this coming correction is actually an opportunity for the younger generation. It's sad for the baby boomers because they're old and they don't have any more coming into the pot, but it's a generational opportunity, I think.
Yeah. When we were talking about the framework in which you're looking at the world, one of the first things you brought up was debt. And this has been a huge issue globally, but even here in the US. And one of the things is I like to look at the US debt clock. And I just looked earlier, it's ticking north of 34.8 trillion. And I feel like every time I bring it, it's just ripping higher. So one of the questions, and then the deficit as well, one of the questions that comes up is like, when is it all going to matter? And is it starting to actually matter? Our growing debt and our growing deficits.
So I think the U.S. is the cleanest shirt in a dirty laundry. And I think this global debt crisis that we all know is coming is going to manifest in a currency crisis, because you can keep printing debt, but at some point there's an imbalance somewhere and it manifests. The release valve is always and will always be currencies. And currently we have a problem in Japan. The Japanese yen is having a problem. It's going to levels it hasn't seen since the 90s. And if Japan blows up, that could spread like wildfire. So currently Japan has got a 250% debt to GDP ratio. The Fed has raised interest rates to 5.5%. Japan hasn't followed. So that's causing a currency issue for Japan. And they're in potentially a doom loop. And I've seen some good analysis that suggests it's the US dollar Japanese yen trade, which is currently priced at around 160, is probably going to go to 300. And the question is, how fast does that happen? If that happens fast, it's going to have a ripple effect. There's been what's called the Japanese yen carry trade. So there's a lot of assets leveraged to the yen. And if that doom loop happens, there could be a a global margin call. So China is also having a problem. China has hit a demographic wall in 2020, and they're struggling mightily to keep their people employed. So that creates global conflict and tension. They're going to need a scapegoat to keep themselves in power. So we get a lot of different things going on away from the U.S. that could light this on fire. Now, it doesn't help that the U.S. is spending $1 trillion every 3 months. That's not helpful. I think that's going to come to an end pretty soon as we get closer to the election, because I really think the deficit spending has been fully to goose the economy into the election.
Yeah, let me ask you that's such a good point. Like, we have the election coming up. You think that will slow down? But my question is, do you think, like, from a political standpoint, will we ever see like a candidate who will actually want to do something, address this issue, or is it something like it would almost be difficult to even campaign on that, like, because no one would vote for it because they might vote in their self-interest if they felt like, oh, if you're going to cut entitlements or anything like that. Just kind of curious, like, from a political viewpoint.
So the reality is we need someone to come in there and pitch austerity, basically. And austerity would be you'd have to pitch it to the nation that we're going to have to tighten our belts and things are going to change. The problem is politically, that's a dead end. So I don't think anybody's going to do it. I think what's going to eventually happen is the capital markets at some point will force that. I don't think that's imminent. It'll probably be when we lose reserve status of the dollar, which I don't think is imminent as well. But eventually, the chickens come home to roost. And we're going to have a bunch of crises between now and then. One is looming. I don't think it's the end of the system, but it's certainly going to be very disruptive.
Yeah. When you say a looming crisis, can you elaborate a bit more there?
Well, the problem is the global economies can't take a slowdown in growth because of the debt leverage. So it doesn't even matter if we get a minor recession. The unwinding of the leverage will have devastating impacts on some financial assets. And then, of course, the Fed's going to come in, cut interest rates, maybe do quantitative easing, maybe do yield curve control. But what we do notice is that every time there's a crisis, and that's just a run-of-the-mill recession, they have to respond with ever greater interventions. And that's the problem. To keep this thing going, it requires more and more interventions, the likes of which we've never seen. The COVID intervention, I want to remind everybody, was perfectly timed because the global economies were rolling over at the end of 2019. And that COVID gave an excuse to the central banks of the globe to print and governments to spend unprecedented amounts of money. And COVID was a war, and COVID saved the system, essentially, I think, temporarily. So that's why we reinflated. It was the first time we'd seen real inflation in a long, long time. And I think, unfortunately, this stick save isn't going to last that much longer. And then we're going to see what the response from the monetary masters and the global governments are going to be to this next crisis. And that's when it gets dicey. I mean, that's when it gets interesting. Will they introduce universal basic income? Will they introduce a CBDC? What happens in the next crisis?
Oh, so that one of the scenarios in the next crisis from where you stand could be, well, two things, UBI and a CBDC, but I wonder if they could probably go hand in hand. But I am curious, like, what is your thesis as it relates to both of those, UBI and CBDCs?
Well, if the crisis is bad and causes enough unemployment, and AI is coming, and that's going to cause also structural changes as well, employment-wise. UBI is hard to introduce in good times when everyone has jobs. It's much easier to introduce in bad times. So if you're going to, as a policymaker, introduce solutions during fear periods, which the next crisis probably will bring fear, if I was running the show and I wanted to implement UBI and CBDC, I would introduce both at maximum fear and panic, and I would tie the UBI to the CBDC. So it's going to be hard to make the CBDC universal, but if you have no means of survival, you'll take both. And that's, if I was going to introduce it, that'd be the perfect time to do it.
Yeah. What would that?
I'm opposed to both of them, but
of course, yeah, I was definitely convinced that, but yeah, I want to hear more. Like, let's explore that too, like your opposition to it as well.
The problem with CBDC is look, you can't trust people with that much power because it's going to be able to link it to everything. A CBDC will be able to link to your credit cards, to every electronic transaction. There will be no cash. Cash will be removed from the system. And essentially, that kind of power will be abused. And I see anybody, getting into power wants to, create some policy about we're going to reduce your meat consumption. We're going to put you on a meat quota. It's just a loss of freedoms. And so for me, the CBDC is very scary in that it's going to take the purchasing power away from us and put it in the hands of the bureaucrats and technocrats.
Let me ask you this as a follow-on. If we reach that scenario where we have CBDCs, and how would you avoid that? Like, what would be like the counter to it as an individual?
Well, clearly crypto is a solution, and that's why we see global governments kind of targeting crypto and making it more difficult for people that hold crypto. I think crypto is here to stay. I think Bitcoin is going to be one of them. There'll be other competing ones, but I think crypto is a significant part of this. We have to all demand that cash still remains in the system. Currently, when I go out into the world, and I put this on Twitter recently, I do not put anything on a credit card that I don't have to. So when I go to a restaurant and it's a $200 bill, I give $200 plus tip in cash. When I go to buy groceries, I give cash. So I'm trying to, do my part to keep cash alive. And when I go to the mainland, sometimes I run into establishments that don't take cash. I just walk out the door and go find an establishment where I can do business with cash. So I think cash has to be a part of this because cash gives you privacy. I don't want everybody knowing what I'm doing all the time.
Yeah. What about gold? Do you like gold?
Gold is also what should be part of everyone's portfolio. Again, it's allocation decision. Do not ever put your eggs all in one basket. Don't have all your wealth in crypto. Don't have all your wealth in gold, because gold and crypto trade like commodities and they will go down in a financial shock. The only thing that doesn't go down is 3-month T-bills. So, you want to have gold in your portfolio, physical gold, as some portion of your allocation. I think gold is going to be a great long-term asset, but it'll have its ups and downs. It trades like a commodity. In the coming financial downturn, gold probably goes down anywhere from 25 to 50%. Crypto will go down. Most everything will go down. In
the downturn, most everything will go down. Okay.
But so that's why Warren Buffett has 3% of the T-bill market. He knows this. This is when margin calls happen in financial panics, and every time the money supply has gone negative, historically there's been a financial panic that comes. It happened in the 30s. It happened it happened multiple times in the 1800s and so this is a real thing. It happens. So when a financial panic comes, people sell what they can, not what they want to. So if you don't want to sell your Bitcoin, but you're forced to, and there's a margin call and you're over levered, it'll temporarily go down in price. Temporarily. Yeah. I mean, gold went down in the great financial crisis 50%. So it wasn't a hedge against that. Now it came back and went to new all-time highs, but if you're a long-term investor, you don't care. But if you're someone that puts all your wealth in one basket, you take a 50% haircut, you might freak out and sell the low. Yeah.
Talk to me a bit like how long you've been worried about this scenario, and maybe even contextualize it, in your career, like in other scenarios that have cropped up that have been extremely worrisome as well. Like, could this be the biggest one we've seen? Just would love a bit more, give us a bit more context.
So the great financial crisis was very scary. I was there, and there was panic. I mean, I'd never seen such fear in my life on Wall Street. But what was interesting was it was a Wall Street phenomenon, and people that were attached to the financial system were freaking out. Yeah, I happened to go to I think Disney that year, Disneyland with my family, and most of the public was just fine. They weren't panicking because a lot of these people weren't involved in the markets, and they were still, even though there was a bad recession, it quickly recovered. And so what's this next crisis going to look like? The problem this time is not just financial, and we don't know what the Fed's response is going to be. So until we see what that is, I don't know how bad this is going to be. It could be just a run-of-the-mill 50% stock correction, or it could be the Great Depression 80% slide in stocks. Don't know yet. But what's different this time is political landscape, the inflationary issues we have now, and the squeezing of the middle class, and the rise of populism is directly tied to this wealth inequality. So things are way more volatile than they were in 2007-8. And there's the sense that a lot of what's going on in our governments is corrupt. A lot of things are coming out. A lot of truths are coming out. So this is a very volatile time period, I think. And there's questions about election integrity. There's questions about even the payroll numbers. A lot of institutions after COVID, health institutions, pharmacy institutions are all being questioned. So there's a way more loss of faith in institutions this time around than there was during the great financial crisis. So it's a toxic brew.
Mm-hmm. Yeah, toxic brew is a good way of putting it. Yeah, it's like a key part of like the fourth turning is that loss of faith and trust in institutions as well. I don't know if you've ever read the book, The Fourth Turning by Neil Howe or anything, but it has come up on the show quite a bit.
No, I'm familiar with it. I'm Gen X. I'm the nomad generation.
Yeah, I'm a millennial, so I think we're supposed to be a hero generation.
You guys are supposed to save us.
That's right. Actually, Neil Howe is coming back on the show on July 12th. We will have lots to discuss. I'm sure of that. But yeah, we're supposed to save everybody. So hopefully my generation can rise to the occasion here. Okay. You brought up a really important part, and this has also come up on this channel with folks, the squeezing of the middle class, the erosion of the middle class. This is like a real concern. I want to hear more on that. They're the ones who are getting hit by inflation, but let's flesh that out and some of the implications when you start to really erode away the middle class.
Yeah, so this is very toxic. It's going to be a topic for the next several years, and it's because you see the rise of populism directly as a result of this. And what's going on is, unfortunately, we have two ends of the spectrum that are doing well: the very rich, and surprisingly, the very low end of the income spectrum, and the new immigrants, the 16 million people that have been let in over the last 4 years, are getting free goodies. And that's actually caused the velocity of money, which had been historically declining since the 2000 top, to pick back up. So the velocity of money has been rising ever since the immigrants have been allowed in. So we're seeing, and that's going to cause a lot of anger in the middle class, seeing that these immigrants are treated differently than they are. And it's a political toxic brew. And I can't predict what's going to happen, but it certainly is not a healthy thing to have a barbell economy where the people at the very low end are basically getting subsidized and the people at the high end are just sitting on their assets, accumulating more wealth, and everybody in between is getting squeezed. It's toxic. And it's going to result in some sort of political action.
Yeah. Inflation has been a major issue, especially for folks in the middle class. And while it's cool, it's still a huge issue. Like, it's still pervasive. I hear people talk about it quite often. Like, I'll just kind of overhear conversations, and the high prices, like if you're at the grocery store or even, the farmer's market, you just hear people talk about it. It is still very much a pervasive conversation. Can we hear more of your thoughts on inflation? Maybe even the Fed's fight against inflation, I want to hear your thoughts there as well.
Well, I think the Fed has made a policy error, and we're going to see a deflationary recession soon, and we're going to see deflation. Now, that would be short-lived, and the powers that be will come in and try to reinflate it. And so I think we're in a period, after 14 years of zero interest rates and relatively low inflation, we're now in a period of volatile bouts of inflation and deflation. It's kind of the end of the debt-based fiat monetary system, because they want to reinflate, but every time they reinflate, it's now transmitting into higher prices into the middle class, which then becomes toxic politically. So then they raise rates to try to curb that, but then that creates a deleveraging scenario. So we're going to have, I think, these bouts of inflation and deflation, very volatile over the next 5 to 10 years. So I think we're going to have a brief deflationary period. I think the rate hike cycle is over. It's over. And the next move is going to be a lowering of interest rates.
Let me ask you this. So do you think there will be, are you of the mindset and in the camp that there'll be a rate cut this year?
I think so. And let me give you some numbers, because I want to talk about this. The relationship between the 5-year and the 3-month T-bill, when it gets below a minus 50 basis point difference, usually indicates the end of the rate hiking cycle. And then there's a plateauing period before the first rate cut. In 2020, once that spread went negative, it was 231 days before the first rate cut. In 2007, it was 294 days. Currently, since this ratio inverted and the yield curve inverted, it's been 469 days. So, and I think, again, the deficit spending has kept this cycle longer. So I think the Fed is making a huge policy error. And I think the unemployment numbers are fictitious at best. And I think the Fed kind of signaled that they were worried about that, because the Fed has said they're looking at unemployment as an indication when to cut rates. So if unemployment is artificially low, whether it's due to, padding the numbers or not, that's a bad signal. So unemployment could be 5-6% and we don't know it, and the Fed doesn't know it. So the Fed's keeping rates too high for too long. So that's why I think I'm leaning towards this being a very bad correction, because the Fed has kept rates too high for too long. And there's, we had bank failures last year. Let's not forget what happened in March of 2023. It was unprecedented. And the Fed came in with emergency bank term funding programs. And the Fed is also doing emergency standing repo agreements with banks that aren't even in the US. Norchunkin in Japan has received lifelines from the Fed. So you can just sense that it's like the Dutch boy in front of the dike sticking his finger in, and then another one pops up. It's like whack-a-mole. So I feel like we're on watch of something breaking, and it happening very fast.
Okay, so the policy errors, I've been keeping it too high for too long. When do you think they should have cut?
I think they should have cut last year. I predicted after the bank failures they would, but they didn't, because they didn't. Because look, here's the truth of the matter. Everyone on Wall Street knows that once after a tightening cycle, the Fed rate hikes, the Fed starts cutting rates, it's a bad sign. And so the Fed didn't want people to think they were scared, I think. So I think once they cut, it's going to be not a 25 basis point cut. I think the first cut will be 50 to 100.
Okay.
But they'll delay it as long as possible, and they'll try to blame some exogenous event. They'll never take blame for the fact that, there's 18-month lags to their policy. So if you think about what happened with COVID, all that spending occurred under Trump. The inflation didn't show up until 18 months later under Biden.
Do you think, what do you think is, okay, if they cut, do you think they'll cut before the election?
I think that all hands are on deck to keep this I call it the MacGyver economy. It's held together with masking tape and gum. They're going to try to keep this thing floating into the election. Okay.
So in the event, like when they cut, and you said not 25 basis points, think like 50 to 100 basis points. In that scenario, what do you think is like the reaction at first? Do you think people celebrate it, or does it make them more fearful? Like, just kind of curious.
Well, the financial markets, the knee-jerk reaction is, Fed cuts are good. There'll be a bounce the Fed will cut in response to a decline in the stock market. There'll be a bounce on that announcement, but then it won't be long lived, and then it'll resume its decline because it's going to take 18 months. Once the Fed starts cutting, it won't affect the real economy until 18 months later. So
because of the lag effects, yeah.
Lag effects, yeah. So there'll be a knee-jerk reaction to financial markets. Everybody will be excited, and then it won't be good. Look, back in 2000, I was there for that top. The Fed started cutting, and the markets continued to go down 50% into Fed rate cuts. And in 2007, the Fed started cutting, and the bulk of the financial crisis didn't happen until 2008. They started cutting in 2007. So Fed rate cuts after a rate hike cycle are generally bearish, in my humble opinion. And we've also seen commodity prices peak in 2022. If you look at the CRB, it hasn't seen a high that was put in 2022. So commodity prices peaked in June of 2022, which is an indication those rate hikes had an effect and they're moving through the system. And I think we're going to see commodities come down once the recession really starts to unfold.
Mm-hmm. Let me ask you about another area of the markets, like where rates also really impact things, and that is real estate, the housing market in particular. Is that an area that you follow? And if so, like, what is your outlook there?
So there's two things. So there's the commercial real estate issue that everyone's been talking about. That's a real problem. It's listen to what investment real estate people are saying that run, investment funds for real estate. They had a conference recently, and they said that most of the banks that hold these loans have no idea what they own, and there's going to be a regional banking crisis down the road. So that's what the real estate professionals are saying. That's bad. The residential real estate demographically is not like it was in the great financial crisis. We hit a demographic peak earning. There's a group of people that are peak earners. They actually peaked out in 2007, 8. So that really was what caused the home prices to go. That we ran out of buyers. The good news is that there's a millennial kind of pent-up demand. Demographically, you guys are entering the sweet spot for buying homes. So residential real estate prices will go down in a recession, but it will be temporary. So if you've been saving up for a home and you still have a job in the recession, buy something when everyone's saying not to. It would be my advice.
There you go. I'm one I want to buy, and I'm going to pounce when the opportunity arises. Ed, you're an astute analyst. You follow so many different parts of the market and the economy. What for you right now? Maybe we'll just do this on the economy. What do you think is like one of these undertold narratives these days that's not getting enough attention?
There's a couple. I think immigration is an interesting phenomenon. It's a political hotbed, but it's actually right now helping the economy because we let these demographics are destiny. Okay, and if you're in a demographic decline, you have growth problems. I can't prove it, but I think this policy of letting in as many people as possible is designed to stimulate the economy and just give them government goodies and they'll spend it immediately, and it's increasing the velocity of money. So and there's also, of course, you want to change the makeup of the country in terms of voting. I mean, the Democrats obviously want more Democratic voters, so they're letting in illegal immigrants. But it also stimulates the economy in the short term. And demographically, and economically, it's a bonus. Societally, it's a disaster because you're letting in people too fast. You're not vetting them. They're not coming in the traditional way, and a lot of these people are unskilled. So societally, it's a disaster. Economically, it actually helps the country. That's one of those funny things that people don't understand.
Yeah, but with the government spending, it's like a short-term boost. What about in the long term?
In the long term, it's not good. I think societally, it's going to change for the worse. A lot of things. Crime will be on the rise. I mean, I have no problem with immigrants, and I have no problem with people from different countries. It's just the quality of the people that we're letting in don't seem to be of the highest caliber.
What is another area that's not getting enough attention from your vantage point?
We're going to be working on a study that showed that this is about gross domestic income per capita for the average middle class. That actually, we're going to put out a report. It actually went up under Trump a lot. We all heard those anecdotes, but it did go up under Trump, and his policies favored more of a wealth equalization. The policies since Biden are more geared towards facilitating those at the top. And that's only gotten wider under the Biden administration. So I think, regardless of what you think of Trump, his policies during his 4 years did increase, per capita income for the average person. We'll be putting out a report on that shortly. But that's what we need in this country. Is we can't have this lopsided barbell system. It's toxic. So if you want a country that's not tearing itself apart, you need to give some more of the pie to the middle class.
Yeah. I know you said you have a report coming. You piqued my curiosity. Would you mind just sharing a bit of the findings, the preliminary findings, at least give us a bit more of a taste before it comes out?
Well, the taste is that the gross domestic income and the per capita income rose under Trump. More than I think we were shocked to see it. So we're going to, that's kind of that's what got us interested, and we're going to flesh it out and look at more data. But we're also going to talk about how you can't have a politically viable society with a barbell like this. You can't have the very poor getting goodies and the very wealthy. You can't have a country with the middle class in decline. You just can't.
Yeah. It's such an important part of just the economy as well. I guess maybe, I don't know exactly how to ask it, but are you worried about the direction that we're headed right now? Or do you have some optimism for the future?
It's like anything, right? I'm a capital markets guy. So when people say, oh, commodity prices are too high, it's actually a good thing, because high commodity prices eventually bring supply to bring lower commodity prices. And low commodity prices bring higher commodity prices. So this bad stuff that's going on, that's been, I think, brewing for 20, 30 years, it's coming to a head. And as volatile as it's going to seem, on the other side of it, we're going to have a renaissance. And kind of I don't think it's going to be as gloom and doom as everybody predicts. I think there's going to be a tremendous amount of change. A lot of the issues that have been hidden underneath the surface that people weren't aware about coming to the forefront. The Federal Reserve System needs to change or get reformed. Government needs to be reformed. The private public partnerships that have formed over the last 30 years have turned into a crony capitalism situation. So we need to go back to kind of a decentralized way of doing things. And I think that's coming. I think we're at peak globalization. Globalization peaked several years ago, and that's in decline. And anybody that's riding the globalization trend is on the wrong trend, in my humble opinion.
What are the implications of that?
It just means there's going to be new institutions rising, more local than global. There'll be a lot of chaos, but a lot of opportunity. You got to remember, in chaos, there's tons of opportunity. Lots of people made fortunes in the Great Depression, while others lost theirs. So don't be in fear, and keep your powder dry. And the world is not going to come to an end. The sun will come up. But if you have your head on your shoulders, you create a business, or you'll create wealth by buying low.
I love that. What a great way to conclude this. I want to give you the final few minutes here, Ed. Let folks know about your work at Phinance Technologies. Let them know what you've been up to there, how they can learn more. You can also let folks know where they can find you on social media if you'd like, and Any parting thoughts, anything that you would like to leave this audience to think about? The floor is all yours.
Yeah, thank you. So Phinance Technologies, spelled with a PH instead of an F, financetechnologies.com. We're a pre-revenue company. We're trying to raise money for a hedge fund. We're having great discussions. We didn't start looking for capital until this year. The prior year and a half work has been on the vaccine issue and following excess deaths, disabilities, and injuries. So we've done a lot of work there. Our website was detailed, all of it. It's thousands and thousands of hours of work done pro bono. My partners are PhD physicists, and Carlos Alegria, my partner, wrote a book called Economic Cycles, Debt and Demographics. He's a genius. He also has a PhD in finance. He has experience on Wall Street as well in Europe. So we're doing exciting things. We're having fun. We're trying to, give opinions that aren't, necessarily the narrative or the mainstream but we think are right. So we may sound crazy at first, but, we end up being right usually many months later. So you can follow our work at our website, financetechnologies.com with a PH. My Twitter handle is @DowdEdward, DOWD Edward. I'm on Getter @EdwardDowd. And we drop reports and thoughts all the time. And at some point, we're probably going to fund the hedge fund, hopefully this year. And we're having great discussions right now, looking for a seed partner to get jump started and give us a significant amount of capital. And in return, they get 20% of our company.
Ed Dowd, founding partner of Phinance Technologies. Thank you so much for being so generous with your time, all of your knowledge. I really appreciate it. I enjoyed the conversation. I think the audience will as well. And we'd love to get you back on maybe later this year as some of this stuff starts to unfold. Really fascinating conversation. I appreciate you so much, Ed.
Thank you, Julia. And yeah, I'll come back in 5 to 6 months' time. We'll see what's going on.
We'd love that. Maybe every 6 months we should do a check-in. Thank you again.